Hey everyone, welcome back to Chip Stock Investor. It's Nick and Kasey.
Howdy.
You would have thought after 3 years we'd have gotten better at this.
Nope. We've been too busy doing other things to nail down the perfect YouTube intro. So we're just going with our normal old awkward selves.
Thanks
But
to everybody.
yeah, thank you. It's been 3 years. 3 years this week that I recorded my first batch of really terrible videos. And Casey edited and uploaded to YouTube. And as they say, the rest is history. But we wanted to say thank you for, if you've been with us all along, for sticking with us. And if you're newer to the channel and to the whole chip stock investor universe, can we call it now? Because I think the whole universe now wants to invest in chip stocks, whereas 3 years ago, that was definitely not the case.
We have a lot more planned for Chip Stock Investor. Make sure you check out Semiconductor Insider over on our website, chipstockinvestor.com, and gets you access to some really cool benefits now and some more in the future. Speaking of the future, make sure you watch till the end of this video.
We're going to tell you all about the future. Also, there's some other surprises too.
No, that's pretty much it.
Oh, okay. Let's get to it. So the first video, we explained why we thought semiconductors were going to be the foundation of the next bull market. Very first actual real full video was avoid Intel. Then we did a series of videos on NVIDIA and their GTC, GPU Tech conference that they were still having in September at that time, twice a year. Talked about Qualcomm's Automotive Day event. And then we did a couple of videos about stocks we were investing in the fourth quarter of 2022. NVIDIA, AMD, Marvell, Qualcomm, Broadcom, and ASML. And so since it's been 3 years this week, let's review how we've done. And this is going to go along with some of the questions that some of you have pre-submitted about where to allocate money in secular growth trends. And like we talked about a few weeks ago when we did our Principles of Portfolio Allocation workshop, a great place to start when you're trying to figure out where to begin investing in these secular growth trends is start from the top. Start with the biggest companies in an industry and then work your way down the list. And then toss out the clear-cut losers and diversify across the rest. That's what we did 3 years ago, and here's how it worked out across those companies: NVIDIA, Broadcom, AMD, ASML, Marvell, Qualcomm, in that order of performance. And obviously NVIDIA and Broadcom, the very big winners, the drivers of this secular trend, semiconductor bull market, secular trend. If you throw Intel out of that basket of stocks, 350% total return over the last 3 years. Now let's take a look at how the semiconductor ETFs have done. SOXX, that's the iShares Semiconductor ETF, and SMH, both fantastic 3-year returns. The iShares Semi ETF up 120%, SMH 200%. Now, I think this maybe just illustrates, this is one of the problems we have with industry ETFs, although these two are very actually well established. They've been around a long time and very successful indices, but in inclusion of even a couple of industry losers can have a really significant impact on your long-term upside, because both of these actually include laggards like Intel that have dragged the indices down. So that's why we like to handpick our own index, let's call it. We start with the biggest companies, the secular leaders, eliminate the laggards, and then throw in a dash of salt and pepper of the mid caps and small caps, which are not included in these two ETFs. They kind of peter out around mid cap, large to mid cap range. Here's a look at some of the specific holdings in those two ETFs. What are the differences between these two ETFs? Specifically, on the last slide we showed you, SMH obviously greatly outperforming the iShares ETF. There's a big primary reason as to why the one on the right is outperforming. The iShares one rebalances quarterly to keep those positions closer to equal weight, while SMH on the right has more of a market cap weighted basket of stocks. In other words, they allow the winners to keep winning and to keep increasing in size as a percentage of the portfolio, closer to the company's market cap sizing and their sizing relative to each other. There's a bit of a lesson here in this whole secular growth trend theme. If you're a long-term investor, less trading usually means more upside potential. This is why we personally favor small adjustments in our portfolio, akin to like what SMH does on the right versus big sweeping changes, especially on a quarterly basis, like what iShares does with SOXX on the left. Let's go back to a broader topic. And rather than just talk about semiconductors specifically, let's go back to talking about secular growth trends in general of the 2020s.
There's a lot of overlap between these trends. Not all of it has to be deemed tech, especially not tech that addresses the same industry. And we have had some questions regarding what is a secular trend versus a fad or a short-term bubble.
When we're talking about these very broad economic themes, we're referring to very big economic changes that will take, in some cases, many decades to filter all the way through the economy. They can also morph over time. And so, like, generally speaking, I think what's interesting about this conversation is all of these themes that you're looking at, these 10 themes that we have listed out that we broadly follow here at Chipstock Investor, all 10 of them are essentially an extension of the secular growth theme that is the discovery and commercialization of electricity, especially starting at the early 20th century. Let's go back to maybe the questions about a secular growth theme versus a bubble, a shorter term fad or a bubble. Let's reuse the chart from Gartner that we talked about, the boom bust cycle, or the hype cycle, I should say.
Especially in the type of economy that we have today, internet, mass, and social media has a proliferation of information that we all have access to. And so it's very easy to confuse a secular trend with a hot fad. Hype can help kick off a new theme within a secular trend, but these boom and bust cycles are shorter term in nature. Let's say maybe less than a decade.
Or sometimes even just a few months.
Right.
It depends. It depends on the fad. Sometimes these fads can stick around for more than a few years and sucker unwary investors into buying kind of that peak hype, which is disastrous. If you realize that a company or a group of companies doesn't have long-term staying power, meaning they can ride the secular growth trend for many, many years, if not decades, you'll need to develop a strategy to exit and come back later after valuations have reset, the trough period in Gartner's chart here, and invest somewhere in there or during the period of enlightenment and productivity where the hype has been removed, businesses are actually doing good work again within this new secular theme that perhaps has emerged from a new fad. That's what you want to try to recognize and really think hard about, whether you're getting suckered into some social media craze or if it's the real deal, real economic change is taking place and productivity is taking place. When you're looking at new potential themes to invest in, technological disruption, in quotes, almost certainly means augmentation of the world as we know it, not total rip out and replace type disruption of what exists. So if a stock or a theme of stocks, if the valuations are implying the latter, complete total disruption, massive growth as a result, rather than the former, gradual augmentation of what already exists, you may have found yourself in a boom bust cycle.
Yeah, just because it's a secular trend doesn't mean it doesn't go through broader economic cycles like the bull and bear markets that we see.
We're going to zoom out here a little bit from the boom bust hype cycle thing and look at broader economic changes, bull markets and bear markets, and how they develop. And sometimes you maybe will see this called like a market breadth chart. And it's a general chart that charts out how many companies or how many stocks are participating in the growth of the market itself, stock prices going up over time. So at the end of a bull market, you have slowing economic productivity from investment initiatives, earnings growth slows, and then liquidity starts getting pulled out of the market. Business investments slow down, and then that's what causes a bear market. Usually it's accompanied with some sort of economic or event-driven thing that catalyzes people pulling money out of the market and catalyzes businesses pulling investments out and their earnings declining. But then at some point, someone comes up with a new idea. It's usually within a prior secular growth theme. Someone identifies a new idea that leads to renewed productivity and earnings growth. For example, in the 2010s, we had mobile computing. Apple kicked off the last bull market in 2008 with the release of the iPhone. Eventually, that segued into software as a service, cloud-based software as a service. That started to lose momentum in 2019, 2020. We had this catalyst that ended up being the pandemic, and then later the Fed rate hike cycle in 2022 that ended that bull market. But then what's emerged out of that? Accelerated computing, NVIDIA, and AI. We humans have a knack for recognizing that great new idea, and everybody starts piling money into that new idea. And so you end up with a very narrow new bull market where maybe just a handful of companies, in the case of this newest bull market, NVIDIA and the Magnificent Seven, as we now call them. But as the bull market ages, more companies join in on the party. They make investments into this new idea. And so the bull market gains breadth and depth. More companies participate. And eventually, we're going to have a reset of this back to step number one. And eventually, we'll have another bear market that resets the whole process.
So the question is, what do you do with your money? If you're in a bear market, or if you're in a bull market, or if you're somewhere in step 3 or step 4, what do you do with your portfolio? It comes down to need.
Where are you at in your investing journey, and what is your need? Just look at this chart here with the potential return and the potential risk, and we'll compare it with this chart here about as you get closer to needing your investments for some future goal, you take some of those less illiquid or more volatile assets and you maybe trim and move it into something more liquid like cash that's going to be stable so that you can use it and you don't run the risk of losing that money. If you're getting close to your goal, it probably makes sense to reduce that position in size and take the easy win, at least in part. If not, maybe you're on the opposite end of that spectrum. Maybe you're a young investor. Maybe you have many decades before you have any need whatsoever of your investments, and your portfolio is still quite small. You should be saving as frequently as you possibly can. And so maybe simply just continuing to deposit money into your account and investing in other businesses takes care of the diversification problem naturally. You just allow the market forces to do the trick for you, and you don't have to touch your big win, and you just let it ride. The other consideration might be how lofty is the valuation on some of these businesses. I think most of the companies that we cover here on CSI are, well, I think many of you like to use the terms overvalued or undervalued as if any of us really truly know the answer to that. We don't. None of us know the future. Because in all reality, I don't know, Kasey doesn't know, none of us really know how overvalued or undervalued a company actually is. And in fact, many companies that ride these secular growth trends will very frequently surprise you to the upside, even though they're quote unquote overvalued. Undervalued companies will frequently surprise to the downside, even though they may look cheap. So that's maybe the other factor though, because every once in a while you do come across a business where you run a DCF or a reverse DCF, whichever your preference is, and you look at it and you say that these market assumptions that get to fair value today are so ridiculously beyond the scope of reality that maybe you just trim and you walk away. But you have to still start with your specific personal need, not some idea about what you think fair value is. Because sad to say, for the classical value school of thought, overvalued versus undervalued is really just another way of saying timing the market. It's a fallacy. It's market timing in fancy clothes. Not that market timing is totally bad. I mean, we do that too. All deciding when to buy and when not to buy investments is market timing.
So if there's always going to be a bear market, how do we deal with the eventuality of that?
Yeah, so the other way you can deal with this is as each year goes by, you might simply just increase your percentage in your portfolio in cash and equivalents or some other stable value investment, short-term bonds, something like that. Maybe it's like 1%, 2%, 3%, depending on your need each year. You increase your cash position by a few basis points. And that's basically what we started doing starting the end of last year, end of 2024. It can really be that simple. We have no idea when the next bear market is going to strike. It could be next year. It could be another 5 years from now. It could be another 10 years from now. Nobody really knows. And anybody that tries to use past market experience to say we're in the final innings or the next bear market's imminent, they're probably wrong, truthfully. So you can keep it simple. Just increase your cash little by little every year. And we'll keep monitoring for more extreme warning signs that might suggest we need to maybe get a little bit more aggressive on that timeline.
Speaking of timelines, let's show our old timeline. So you may remember this slide that we created a while ago.
2 years ago?
2 years ago. And there's obviously been some changes to this, like that big blue arrow that you can see right there. We never said that this was a chart based on our own private crystal ball. Obviously, we can't know the future, but let's take a look at our updated chart.
As before, this is just a guess on what could possibly happen. But let's start with what's changed. We replaced the blue arrow with the pink arrow. The blue arrow was referring to what we thought would be possible excess semiconductor manufacturing capacity sometime by the end of the decade. As it turned out, it happened starting in about 2023, and it's still kind of ongoing today. And the excess manufacturing capacity hit the IDM market, the integrated device manufacturers, the Intels of the world, the microchips, Texas Instruments coming out of a prolonged slump. So that changed. We also updated the semiconductor end market sales figures. This year, the semiconductor end market sales is expected to be at least 700 billion, perhaps 750, maybe even some estimates point to possibly 800 billion. Of course, accelerated computing and data centers are driving that growth. It was 630 billion in end market sales last year. The expectation for 2026 is that number exceeds 800 billion. After that, perhaps starting in 2026, maybe into 2027, maybe we have a down cycle. Maybe there's a short-term hit to demand for AI data centers. Accelerated computing takes a step back for a little bit. Who knows? We'll have to wait and see. But we still think the old estimate that sometime around the end of this decade, and the semi industry believes this as well, that we're going to hit $1 trillion per year in end market semiconductor sales. Pretty crazy. Backbone of the bull market of the 2020s. And then the final thing that we changed here in 2030, we changed this from excess semiconductor manufacturing to maybe something a little more end market focused. And obviously this would affect semiconductor manufacturing as well, but excess capacity from overinvestment in AI data centers. The overarching theme this decade is hardware and infrastructure investments, which is very different from the 2010s, where it was very asset light driven. In the 0% interest rate environment, a lot of companies were stagnant. They invested in software subscriptions. very asset light for most companies. This growth cycle is very different, and it's going to be much more wild and more cyclical in nature. And I think a lot of investors have never experienced that before. Ultimately, all the volatility that we've come to expect, especially the last few years, 4 or 5 years in particular, we think are going to be a hallmark of this bull market. There's going to be a lot of more cyclicality to this market versus last decade, where it was kind of more smooth because nobody had to invest much capital to unlock earnings growth, because you just fire up a software subscription and then you just invest in SaaS stocks and straight up and to the right, at least it seemed. And then finally, what happens in 2030 and beyond? Quantum computing?
Yeah, quantum computing, and we're going to have a robot in our house.
You're crazy.
That's only 5 years away.
I know.
I'm not so sure.
Maybe it's SaaS 2.0 in the 2030s, maybe like AI software, SaaS 2.0 bull market, or more than likely it's something else entirely that we haven't
even anticipated.
Nope. And we haven't even coined a term for it yet. But anyways, there you have it. Enjoy the ride until then. And we're, super happy that everybody's chosen to be here with us over the last 3 years.